But I want to thank everyone for joining us today. This is a new series from the UW Extension Farm Management team. So we hope it is well received and hope we have the opportunity to dive into some interesting topics. The motivation for this series kind of comes out of two facts that this year has been a sort of busy and somewhat strange year on the ag policy front, which has major implications for farmers' bottom lines here in Wisconsin. And the second thing is that over the last few years, the farm management team has kind of pulled together a contingent of policy, economic, markets, and legal experts to be able to provide input and education on these topics. And so, kind of marrying those two things together, we thought for the first time this fall in 2025, we would have somewhat of a 4-week webinar series where each of the weeks we dive into a new topic. And so today we're going to hear from Silva Gaku, Dr. Silva Gaku, who is our Extension Farm Management, Farm Financial Management Outreach Specialist, and Dr. Paul Mitchell, who is the seasoned veteran of the group that I'm sure many of you no, but they'll be talking about updated commodity support programs, particularly for grains in Wisconsin. Next week, we'll hear from Kelly Wilfert, who is the Extension Farm Law Outreach Specialist, and she'll be talking about tax changes in the One Big Beautiful Bill Act. I think that'll be a really relevant and important conversation to join next week in. And then on December 1st, we'll hear from our dairy markets and policy outreach specialist, Leonard Polzine, on changes to dairy risk programs, the impacts of dynamic trade policies that have been unfolding in this last year, and kind of market outlook moving forward. And then wrapping up on December 8th, we'll have kind of a miscellaneous topic. If there are things that we don't have time to touch on, I will touch on them on December 8th. And then just kind of a more bigger picture conversation about what maybe U.S. agricultural policy looks like moving forward, given kind of this polarization that has happened and how ag policy has kind of unfolded in the last couple of years. So one of the things that is not and intentionally not included in these four topics is trade. And I know trade has been on the front of all of our minds this last year. But I want to give an advertisement for the Wisconsin Ag Outlook Forum on January 27th. And you can register at the link below. But during the Ag Outlook Forum this year, we're going to dive deep into this topic of trade, hear from practitioners here in the state, and how folks have kind of navigated and been resilient through some of the trade disruptions that have occurred this year. So the four topics that we're going to cover in these 4 weeks are kind of meant to be a supplement to our annual capstone event which is the Ag Outlook Forum, but for diving in deeper to some of these more specific topics throughout these 4 weeks. So how today will unfold is that we're going to have two different presentations for a total of about 30 to 40 minutes. And then we'll have 10 to 20 minutes of Q&A and just kind of roundtable discussion among myself, Silva, Paul, as well as Kelly and Leonard, if they're able to join that conversation. And as we're talking today, please post your questions in the chat. There should be an option for Q&A down below, and then I will facilitate those questions after we wrap up both of those conversations. I will say that the recordings will be posted online afterwards, so if you happen to miss one of these weeks, feel free to come back, and I'd encourage you to revisit them later. And then lastly, we're going to have two polls for you all to fill out. The first of those being just demographic information for our own reporting purposes. It should be pretty quick, and I think Silva will release that poll here in just a minute. And then after we get done with the first presentations, we'll also have a poll for feedback where it's an opportunity for you all to provide input onto what we might talk about in the future. So that's our format for today. I won't take any more time, and I will stop sharing my screen and allow Paul to share his. But we're first going to hear today from Dr. Paul Mitchell, who's going to talk about maybe kind of how that the sort of landscape for commodity support programs this year, and then I think Silva's going to dive into how they have changed this year and maybe what to expect moving forward. So Paul, I'll turn it over to you.
Thanks, Jeff, and thanks everyone for being on. We're trying something new. So the one thing I think I'd like to remind everyone is just it's going to be fairly informal towards the end. So we'd like to have some discussion if people are open for it. But why are we doing this ag policy series? This year, ag policy has really gotten less predictable. We had the 2018 Farm Bill that expired officially on the 23rd of or September 30th of 2023. That's where we traditionally did our commodity support programs, our conservation programs, crop insurance. That was what we always kind of waited for. Wait for the Farm Bill, do the updates, and then help people make decisions based off of the new programs. The Inflation Reduction Act passed in August of 2022 that had conservation programs, a big change in terms of funding levels in some of the climate smart ag programs. That was unusual. That's outside the Farm Bill. We had the Farm Bill extended in November of 23 to go on for another year until the end of September of 24. Then in December of 24, just before the end of the year, we had the American Relief Act of 2025 that passed in 2024. Again, it extended the Farm Bill another year. So we kept waiting for these Farm Bill programs to be updated. And then we also had a couple new programs, the Supplemental Disaster Relief Program, SDRP, I'll talk about shortly, and then the Emergency Commodity Economic Assistance Program, ECAP. I'll talk briefly about them as well to see what they've done. Then in July, we had the One Big Beautiful Bill, had some updates to the Commodity Support and Crop Insurance Program that Silva will be talking about for the future. And then just last Friday, we extended the 28, that's the 2028, I'm sorry, the 2018, that is a 2018 Farm Bill, another year. So, because there's some programs that weren't addressed by these, the One Big Beautiful Bill and such. So the Farm Bill's been extended a third time now as of last Friday. So there's a lot of uncertainty in these changes. It seems to be happening outside the Farm Bill. So this is from February of 2025. This was farm income over the last several years. Inflation adjusted, so we've taken care of all that. What you see is a big number, 180 billion. It's the second highest ever. It's a big jump from 24 to 25. Second highest in the last 50 years, about 25+% over the last year, big, well above the long run average. They just updated this on September 3rd, and it's essentially the same. I didn't even update the slide. I just crossed out the 180, put 179. The little blue line and the little red line would move a slight bit because of inflation, but essentially it's a big up. So why are we so concerned about farm income this year? It seems like it's doing great, second best ever. I think it really, and I think a lot of you online will know this, it's a split. Are you talking to crop people or are you talking to livestock people? Crop revenues were down from 23 to 24 a lot. And then they're down even more from 24 to 25, almost 4% for corn is cash receipts coming in down. Soybeans down over 7%. Wheat is down almost 10. On the other hand, livestock looks great. The revenues, the cash coming in, if you're selling cattle and calves, almost up 16%. Dairy's flat is the only one that actually has done anything downward in this USDA data in September. Broilers are up, eggs are up, everything's up, up, up. Livestock crops are down a little bit more compared to last year. And the hard part has been these prices are down, these cash receipts are down from 23 to 24, from 24 to 25, but we haven't seen any reduction in costs. Usually we see a small, at least some pullback on costs, inputs, but we haven't really seen that. And these are slides I put up here. This is what would have been back in the spring, before we planted back in January, February, March of 25. And these were the break-even numbers. This was how many dollars per bushels corn after corn, corn after soybeans, or soybeans needed in northern Illinois or in Iowa State's budgets or UW-Madison, the Division of Extension budgets. What you see there, 490, 462, 1130, 483, 420, 1115, almost 520 or 1270 for soybeans here in the state. These prices are still high. So back in February, what we see, the expected farm level prices, the average, the marketing year average across the whole year at the farm level, 420 for corn and 1010 for soybeans. That's negative margins. We weren't going to pay anything. Well, you're not going to make anything. You're going to lose money on growing corn and beans for the full cost of production. Last week, the U.S. government opened back up again at the federal level on November 14th. On Friday, they released their updated price forecasts. Corn is now $4 instead of 4.20. Soybeans is 10.50 instead of 10.10. So we've had some updates to these. Still haven't solved the negative margin problem, but what I wrote back last spring, the average Wisconsin farmer is expecting a negative margin about $1 for corn and just over 2.50 for soybeans in 2025. With these updated prices, the margins got 20 cents worse for corn, so went from $1 to $1.20 negative, and for soybeans it got a little bit better, but it's still over $2 a bushel loss. Just want to note these are the full costs of production, including time of the manager and labor, as well as paying for the land rent and everything. So, this is negative margins. This is not good. This is on the crop side. That's what these decline in cash receipts means with the cost staying up there. Negative margins. And so what's really happened is the cash flow problem has gotten larger for lots of farms, including many in Wisconsin. It's the land values have been holding, so they have value, they have income or property. They got a solid balance sheet, but they just don't have the cash flow because the crop prices are down. So this is the seventh district. This just came out on the 13th, so Thursday last week. And these are these indexes of loan demand, repayment, and renewal or extension. And I'm really just showing this as how in the last 12, really year and a half or so, we've really shifted from having people paying back to loans to switching over to this cash flow problem. The red line is loan demand. And looking, this is as the third quarter, so as of end of September of 25 here, just a few weeks ago, really. Red is demand is up. That means people need more cash. Green is loan repayment. It was paid. We were paying back loans like crazy, and then it's flattened back out again. And the blue is loan renewal or extension. Has really been falling off. So loan demand is up, payment is down or flat, and renewal extension is down. We're just people are running into cash flow problems. This is for the seventh district. That's what that little map there is. So it doesn't include all of Wisconsin, but it gives you a sense. Farm conditions, the financial conditions are eroding. So the government's response has been is support, providing financial support for farmers. This came out and this was updated in September 3rd. This is the last 6 years worth of, well, 5 years of actual and 6 years. The sixth year is projected payments to farmers and direct payments in various forms. You go back to the pandemic on the left there, you got that orange and maroon. That's all this PPP and CFAP payments that were during the COVID pandemic when the economy was in rough shape. Then since then, it's been very flat, but over about 40 billion of that 180 billion of farm income we saw is actually program payments of various sorts or government payments. There's a green at the bottom is standard conservation programs, but that big gray box is ad hoc programs. Something other than that little thin green bar, darker green bar is things like ARC and PLC and other standard farm bill programs. So what are these? Well, back in December, at the end of the year, we had the Farm Bill extended, but they also added some programs because they knew the farm economy was in trouble, especially on the crop side. They had two programs, Supplemental Disaster Relief Program is this first one, 21 billion for crops and livestock. This is for losses to disasters for the 23 and 24 years. Sign up started July 10th. It's technically still open. And then there's a phase two was targeted to begin in October, is what it said on the webpage. I'm sure it's going to be rolling out soon. It was originally for those big disasters down in the southeast with the hurricanes, but you can see where the money's gone in the stage one payments, all in the down the Great Plains there, from Minnesota down to Texas. Wisconsin's received 130 million so far. Minnesota's got I think it's the largest in the nation, almost 667 million, and et cetera. That was so far they've only given out 5.7 billion. That's out of the 21. So there's less than 30% has been given out. So there's still more to come. We'll see how that goes. You should be hearing about that. This 130 million that should be helping with cash flow for those who received it. There's more to come in the state and elsewhere. The other one is this ECAP program. Same time period. This should have rolled out and people should have received these payments. There were $10 billion in payments for the 2024 planted acres. This was to make up for the Farm Bill not having been updated yet. And so this was based off what you planted. You can see the payment rates there were pretty high, $43, $30 for corn and wheat, or soybeans and wheat, $78 almost for oats. Most of that money's been given out. 9.3 billion has been spent so far of the 10. Wisconsin has got the 235. I did the math. The max we'd ever get would be about 245 million in the state. So, and that's if you took all the planted acres in the state and paid them at these rates. So we pretty much, just like the rest of the nation, pretty much maxed out those ECAP payments. There's just a little bit left to go. I'm guessing they'll go out here pretty quick now that the government's back open. So those programs should have been helping with cash flow issues. The other one that people might have forgotten about is ARC, Agriculture Risk Coverage. The old Farm Bill program hasn't really made many payments for the years, but these are for the 2024 marketing year, which ended, or crop year, which ended in the marketing year when September 30th. Normally, these payments would have come out in October with the government shutdown. They should be flowing. They might have started last week even or before. But you can see we've had some big ARC payments for 2024 triggered for several counties in Wisconsin on the corn side. These numbers are hard to read on the map, but they see the figure on the left, the legend, $60 to $88 for those dark green counties. You got along the eastern side there of the state, along Lake Michigan, and then a big patch over there in sort of the northern part of the central corn area there. Big areas there, and corn, soybean is a little bit less, but still 50 to 63. Again, along the eastern side, except for that Manitowoc, Calumet counties are very little, but all the way down into Racine and Kenosha counties. Again, that same pocket in the northern part of the central area there, Marathon, Wood County, and sort of northeast of there. I'm sorry, northwest of there. So those payments should be coming out soon if you haven't received them yet, with the government shutdown ending. Wheat notes also generated some for a few select counties, usually not a lot, but you can see some of these counties in western or extreme northern, again along Green Bay area there, we've seen some payments out for wheat notes. Not quite as large, but again, these payments should be rolling out soon. We put out a little news blurb about this last week. There's a little link there for the article if you want to read it. The last thing I'll talk briefly about is the Trump administration has been hinting for a while that there might be more money coming. We've heard nothing, but these are all headlines I just got off the internet from different dates, sort of back. Is it 3 billion? And the top one there on the top left, is it 10 billion? You've heard 12 billion. All these numbers, we see nothing specific, but these are just talked about. With the shutdown ending, and if this is serious, maybe there will be something, but there's nothing concrete yet. But if we get a program, I expect something like the ECAP program, maybe so many dollars per acre for 2025 planted acres. We'll just have to wait and see if there is going to be one. So basically, policy seems to have moved outside the Farm Bill. In our current situation on the crop side, especially, as cash flow is a serious issue for many crop farmers. Congress has responded that SDRP and ECAP payments should have helped. Will there be more SDRP in the state? I'm not sure yet. Wait and see. And ARC payments for 2024 should be coming soon and should also help. Silva will pick up on what's going on with 2026 and the one big beautiful bill. And then, of course, the big question is, will we see a 2026 Farm Bill? I'm going to be done there, and I think Silva's up next.
Awesome. Thanks, Paul. Yeah, next we'll have Dr. Silva Gaku, and just a reminder to please post any questions about Paul's presentation or thoughts that maybe came up in the chat or in the Q&A portion.
Thank you so much. I'm the Farm Financial Management Outreach Specialist here, and I will be walking you through the One Big Beautiful Bill, specifically the changes as pertaining to Agricultural Risk Coverage, ARC, and Price Loss Coverage, PLC. And we would also delve into some crop insurance changes and look at adoption rates across the state. Before we delve into the changes of that are affecting these two programs, I want us to go through how these two programs work. For PLC, we see that the payments are triggered when national marketing year average price goes below the effective reference price. The effective reference price here is the price floor that is deducted by the Farm Bill or the One Big Beautiful Bill in this case. Looking at ARC, producers who elected it receive payout when actual county revenue goes below the county revenue guarantee. And the revenue guarantee is calculated as what the Olympic average of county revenue for 2020 all the way to 2024. and 86% was taken of that under the 2018 Farm Bill. But under OB3, I'll be referring to the One Big Beautiful Bill as OB3. And under OB3, we see that we take about 90% of that Olympic average to determine the county guarantee. I must assure you that we will be posting spreadsheet of Wisconsin prices, county yields, and guarantees shortly. So please be on the lookout for these on our pages. Looking at the changes, we see that the effective reference prices, that is the price floor for these two programs, have increased as a result of the passage of OB3. Under the 2018 Farm Bill, corn would command about $4.26 as its effective reference price, but under the new Act, OB3, it has increased to $4.42. Using the projected market year average price of $3.90, producers of corn who elected PLC should be expecting some payout. When we also examine soybeans, OB3 also increased the effective reference price from $9.66 to $10.71. And using the projected market year average price of $10, producers would expect some payments in 2026. Tracking the changes over the years, for corn, as I already mentioned, in 2025 cropping year to 2026, if the price stays around $3.90, producers will receive payout for PLC because it has been triggered and because what the market year average price lies below the effective reference price. In 2024, we do not see that. So producers who elected PLC in that marketing year would not receive any payout for that. For soybeans, using the OB3 values, we'd also expect some payout for producers who elected PLC, hoping that the market year average price remains around $10. And with that, we will see payouts being triggered in 2026. But if you trace the history of this program, the PLC, you'll see that payouts have not been triggered over the years. But with this change under OB3, producers should expect payout if the market year average price remains around $10 per bushel. Now moving on to wheat, with the change orchestrated by OB3, producers would also experience market year average prices lower than the effective reference price. That means payout would also be triggered for wheat if things remain the same. Moving on to oats, we would see that payout will not be triggered for PLC in 2025 because the current market year average price, the projected market year average price, lies a little above the effective reference price of $3.05. So moving on from PLC to ARC, what we say is that there has been an increase in the guarantee. So increase from 86% to 90%. Taking Adams County, for instance, in 2024, the county guarantee was $804.80 for irrigated corn. That moved up to $842.23 if it were under OB3. Secondly, we also see an increase in the maximum payment rate for ARC. This increased from 10% of the benchmark to 12%. With this increase, taking Adams County again, for instance, we will see that the maximum payment rate for irrigated corn would have risen from almost $94 to $112.30 under OB3. Aside those changes, we also see that the share of premium paid by producers has also declined for higher coverage levels. The previous premium share, which you see on your screen, we have the optional unit and basic unit, as well as the enterprise unit. And under OB3, we have the new basic, optional unit, and enterprise unit share of premium that producers will pay. From what we observe over here, we see that the passage of OB3 has resulted in a decline in the share of premium that producers would be paying going forward. So higher coverage levels will now cost less than before. Taking 85% coverage level, for instance, producers under the 2018 Farm Bill were paying about 62% of the total premium under basic or optional unit. But under OB3, they will now be paying 59% of total premium with basic or optional units. What does this then mean for farmers? This then means that as a producer, you should consider or evaluate increasing your coverage level because they are now relatively higher, they are now relatively cheaper at higher coverage levels. Beginning farmers are not left out of OB3. And what we see is that they are to receive an additional 15 percentage points reduction in the first and second years. So taking the new premium share into consideration, we'll see that for coverage level 85%, under the new premium share, producers were to pay about 59% if they have basic or optional unit. But a beginning farmer or rancher with basic or optional unit will be paying only 44% of total premium. This means that crop insurance is now relatively cheaper for the next generation of farmers. Now we move on to supplementary coverage option, and I would walk you through how this program works before I tell you or we discuss the changes in OB3. This program follows the coverage of the underlying policy. So if you choose yield protection, then it will cover yield loss. But taking revenue protection, it would cover revenue loss. So taking revenue protection, for instance, SCO triggers when county revenue falls below 86% of its expected value under the 2018 Farm Bill. Under OB3, it triggers payout when county revenue falls below 90% of its expected value. Taking, for example, revenue protection, a farmer with revenue protection and 75% coverage level, and he or she dwells in a county where we have expected value of around $800 per acre, we see that payout would be triggered when county revenue falls below $688 under the old, let's say, 2018 Farm Bill. Under OB3, payout will be triggered when it is lower than $720. So under the 2018 Farm Bill, amount of protection is around $88, but under OB3, producers are covered up to $120. So here we see that producers under OB3 have better protection than they used to have under the 2018 Farm Bill. And it is something for them to consider in this case. What other changes do we see aside the increase in coverage rate from 86% to 90%? We also are now able to combine ARC with SCO. Under the 2018 Farm Bill, this was not possible, but now producers are able to do this combination. Producers' share of the premium has also declined from 35% to 25%, 20% of total premium. So taking total premium of $100 per acre, for instance, producers were paying about $35 per acre under the 2018 Farm Bill. Under OB3, they will now be paying only $20 per acre. Producers should then consider SEO because it is relatively cheaper. Now, it also offers better protection as well. Moving on with ECO Enhanced Coverage option, this program also follows the underlying policy selected by the producer. So if the producer were to select revenue protection, ECO would trigger if county revenue falls below 95% of its expected level. With a 75% coverage level and an expected value of around $900 per acre, payouts for ECO are triggered when county revenue falls below $855. Producers will receive full amount if, let's say, county revenue falls to $774 and the amount of protection is $81. In addition to that, we also see that the producer's share of total premium has declined from 35% to 20%. Well, despite all this, we also want you to see the adoption rate across the state. We are focusing on these four main crops: corn, soybeans, wheat, and oats. In the table to your left, you will see the tables that is in short acres, and the table on your right, you see the percent of planted acres that are enrolled in SEO. So focusing on 2024 and 2025, we see that for corn, there has been a decline in short acres for SEO. The same for soybeans as well as wheat. That for oats has increased marginally from 417 acres to 437 acres. When you look at the table to your right, you see that the percentage changes from 2024 to 2025 reflect this, what we see on the left. There has been a decline in the share of planted acres that is enrolled in SEO, or that is ensured by SEO. But that of oat remains the same from 0.3% in 2024 and remains constant in 2025. Now, looking at ECO, the insured acres, over the years from 2021 all the way to 2025, and see what share of planted acres are enrolled in ECO, we also see that from 2024 to 2025, there has been an increase in enrollment or in the adoption of ECO. And this we see that the share of planted acres enrolled in ECO has increased significantly from 2024 to 2025. Looking at corn, for instance, it increased from almost, 9% to 31% of planted acres in Wisconsin. For soybeans, that rose from 6%, almost 6%, to approximately 21% in 2025. One would say, how does this, relate to maybe indemnities and then the payment of these premiums? So we put together the loss ratio, the producer loss ratio, and this takes into consideration the subsidy that producers may have received for enrolling in these two programs. When we look at corn, a value above 1 simply means that producers have received more indemnities compared to the premiums that they have paid for that particular program. So looking at corn, for instance, In 2023 and 2024, we see that indemnities or the amount rolled out to these producers far outweigh how much they paid in premiums. We are awaiting values for 2025, or as things wrap up, we would put together that in our next articles that we'll be putting up. When you look at soybeans, this only occurred in 2024 when producers received more in indemnities than the premiums they paid. For wheat, that also occurred once, as well as for oats when they enrolled in SEO. For ECO, we see that corn in 2023, they have a value of a loss ratio of almost 2.5, meaning that indemnities were almost twice or were more than twice the premiums that producers paid for enrolling in ECO. The same in 2024 for corn growers who enrolled in ECO. For soybeans, we also see the same thing happening, indemnities far outweighing the premiums that producers paid for that. For wheat, that also occurred once. And when you look at oats, we see that for the years we have looked at, 3 out of those years, producers received more indemnities than the premiums they paid for enrolling in ECO. With more data, we would be giving you more information about the loss ratios in 2025. What does this mean then for you as a producer or someone educating producers? Under OB3, we are seeing that higher coverage levels are relatively cheaper than they used to be. This means that for a farmer, you would want to examine enrolling in a higher coverage level. So if you used to insure your crops at 55%, you may want to consider moving a little bit higher than 55%. But these will provide more information to help you in making that decision. Under OB3, we also see that the share of premium paid by producers has declined from 35% to 20%. This simply means it's relatively lower compared to what producers were paying under the 2018 Farm Bill. What does this mean for you as a producer? You may want to consider buying these two programs to cover shallow losses. Now, with the change that we are seeing with ECO percentage coverage increasing from 86% to 90%, and 90% producers are able to access ECO via ECO. What would I say with all these changes that we are seeing under OB3 and policy in general? I would say that we would be putting out more write-ups or more relevant articles for you to make decisions concerning these things. For instance, in enrolling in new acres or new base acres, we would put out more information after FSA has provided some guidelines on enrolling these base acres. As Professor Mitchell has always done, we would continue in that pattern to provide clear sign-up recommendations. This we'll do by providing some new tools and data to help you make that decision as well. For ECO and other crop insurance programs, I would also state once again that we'll be making available more materials or new materials, and recommendations would also be offered for you to take that decision. If you are also considering increasing the coverage level for your current crop insurance, please be patient with us. We will be providing more information about this soon. If you have any questions, feel free to reach me on the following number or send me an email. And I have other articles available on my website that you could also read that could help in your farm decision making. In addition to that, I have some tools on my website, which is on farm cash rent. You can access this by using the barcode or the QR code over there to see the cash rent for the entire US. That will be all for today. Thank you.
Great. Thank you, Silva. I'm glad you mentioned your tools that you have here at the end. If you weren't going to say it, I was going to say it too. So there's Silva has a lot of great resources around ARC and PLC. You can look back and see historically what Wisconsin producers have received, and so you can kind of see how some of those decisions might stack up. So if you visit Silva's website, a lot of those tools for ARC and PLC for cash rent are listed there as well. So there's a lot more resources that weren't shared here today. So yeah, so thank you both. Again, I will ask you all, our participants, our attendees, to post questions in the chat if you have any. I have a couple for us just to get the conversation started. I think while we start these questions too, Silva's going to post our second poll, an opportunity to give feedback if you have time before you hop off the call. But we'll have about 10 minutes here or so for questions. But Paul, first question for you relating to your material. You know, I've presented these break-even prices before as well, and sometimes folks are always like, why do farmers still grow corn and soybeans if they're losing, you know, $1 or $2 a bushel on them? So do you have a response to that?
Yeah, what I emphasize is that that's the full cost of production. It's supposed to pay for your time and effort, your management ability, and for the land. And some farmers are willing to take a lower rate of return in order to farm their land. And you know, it really comes down to you're not paying yourself a fair wage, is what it boils down to. But you're staying in business, and some people are willing to do that in the short term. And also, they're generating feed if they're having a livestock operation, so they're also willing to lose money on the corn in order to make money on the milk, or which, however. So that's what I try to emphasize. Those areas, the full cost of production. And then, frankly, some people they just stay in the business at that level because a lot of those are what we call opportunity costs. You know, like the time and the energy. If you already own your land, you don't have to pay rent on it. You're not paying a mortgage on it. So farms that are have a lot of leverage, a lot of mortgage payments due, or they're renting a lot of land, those are the ones that are very vulnerable to these negative margins because they have to survive, and you have to pay your rent, you have to pay your mortgage. But if you already own it, you don't have to necessarily pay yourself as much. The last one are just the people that are sort of late in their career and they don't see a viable heir coming. They think, you know, do I need to wait until the next run of high prices or am I done? I just don't see it happening, you know, and they might think about moving on into doing the next thing. So that's what I emphasize in those. Those are sort of, and they're also industry averages. Everyone is not an average farmer. Everyone's obviously lower cost and gets better yields than we assumed, you know, but
Yeah. Yeah, and I mean, you brought up too all of the sort of supplemental payments that have been made by the government, right? And those are not included in those break-even prices, right? Like the ECAP payments, supplemental disaster.
right, right. That's again, that's what keeps some people going is some of that cash flowing through these tight margins are things like that as well.
Yeah, I mean, so even if the ECAP, right, was for the 2024 crop year, right? It's like what you planted in 2024. I was doing some quick math, but if you're getting $43 for corn, is that right?
Something like that. Yeah, if I remember right. Yeah.
For each acre of corn, right?
Right. A planted acre of corn.
And if you are averaging about 180 bushels per acre, then that changes the break-even price by about 23, 24 cents.
Right. And
If
that's the weirdest thing about, and the same with ARC and PLC. We're receiving ARC payments for 2024
yeah,
this week, probably. Well, yeah, this week. You could be harvesting your 25 crop, getting your ARC payment deposited in the bank, and then buying your 26 inputs, your
yeah,
prepayments on your fertilizer or your chemical or seed, all the same week, which
yeah,
is kind of a weird cash, but that's the reality of U.S. agriculture, that cash flowing, you're using 24 money to cash flow purchases of 26 inputs.
yeah.
Um, Yeah.
Yeah. So with all of those things stacked on top of each other, we're actually probably closer to that 520 than maybe the
Yeah,
market
that's
price, you know.
yep, yep. That's a very good point too, because you got all those other payments helping out in that. Exactly, exactly.
Yeah. Yeah. Maybe a question for Silva and maybe Paul too, because I know you've worked in this space for some time too. But specifically for that crop insurance, Silva, you mentioned that you think that folks will probably be investing in higher, or you might recommend that folks invest in higher coverage levels. So I don't know if Silva, if you want to pull that slide back up, but that chart that showed the different coverage levels and the share that would be paid by the government. So what do folks typically or historically invest in? What coverage level do they invest in? And then, maybe showing kind of like on the margin what one big beautiful bill may have changed that decision some, right? So you gave the example of 55 to go up to 60, right? But most folks are um, somewhere in the middle there, right?
You muted.
I
Oh,
think you might
okay.
be muted, Silva.
Oh, great. Thank you so much. Yeah, so we see sometimes people enroll in the 75. And then with that, they could also increase coverage to maybe 80%. That's what I have seen.
Hmm.
So that's likely to also be lower, like we have seen. So they could probably move up a little bit on that.
Gotcha.
I would need to maybe give you maybe a full detail. Maybe Professor Mitchell might have more data about the distribution across the coverage levels over the years.
Yeah, historically in Wisconsin, most people are getting that 70, 75, 80%. I haven't checked the last few years. It might be creeping up. But the one thing when you were presenting, Silva, I also realized there's two effects going on here with these subsidies that there was this program called well, it was a proposal called supplemental deductible coverage. SDC. It was proposed as something that never got out of committee. This would have been like the '08 Farm Bill or the '09, way back then. And I did an analysis of it, but it's very much like ECO, SCO. And it has this, it was essentially supplemental deductible coverage was today's SCO, ECO. And it had this effect that if you would ride the county policy, you would then cut back your insurance level, your traditional insurance. And so basically, I don't think we know the answer of what the heck to do right now because they've lowered the price, the cost of insurance goes down. The subsidy went up, so the price goes down. So that increases demand. If it costs less, I'm going to buy more of it. But at the same time, maybe I should take that money and go buy ECO or SCO and then buy less of the direct coverage. And so I think this is one of these two-handed economist problems where on one hand you get this effect, and the other hand you get this effect, and we don't know the answer. Um, I do remember on supplemental deductible coverage, which is essentially the availability of ECO and SCO, it never moved anyone much more than one jump from like 70 down to 65 or from 75 to 70. It never went from like 75% coverage down to 55% coverage. There was never a big effect. It was always a small effect. So my inkling is the price effect to making it cheaper will cause people to buy more of it. And then this ride on the ECO SCO will cause you to buy less of it. On average, farmers are going to stay about the same and just use less money to buy insurance and go do something else with the money. That's my intuition right now. But there are two effects, and we technically don't know the balance of what will happen. But my intuition is it won't be a big effect. We'll see, though. We'll see.
Yeah, maybe so last question, maybe kind of wrap up our conversation. I'm going to ask you both maybe to make kind of a prediction. These are things that make me uncomfortable as an economist is making a prediction, but with the changes and the sort of economic outlook and the markets, how they've kind of evolved, I think what do you anticipate being the biggest change that producers might make going into the next crop year? Maybe it's ARC versus PLC. Maybe it's these different coverage levels, like you mentioned. Maybe it's not growing corn and soybeans anymore. I don't know. Do either of you have a prediction on what we might see, what these changes might drive when it comes to actual decision making?
I think there's going to be a lot of people looking at PLC this time around, just to see, because before it was never really a
Mm.
very strong option, but I think now it's not going to be clear. And my worry as a professional is supposed to be giving people recommendations is the recommendations are going to be complicated. Under these conditions, PLC is better. Under these conditions, ARC is better, and I don't know which one you're in, and then you got to do and blah 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 blah. And you're trying to help. It's not. I don't. I'm worried it won't be quite so simple that we're going to have to spend some time this year looking at PLC. And then I think farmers are just plain simple going to be looking at their crop insurance again and really thinking about what coverage level do I want? Do I really want this ECO, SCO, and do I want both or one? I there's going to be a lot more interest in understanding both of those programs, ARC PLC and the SCO, ECO, and do I adjust my revenue protection coverage?
Yeah.
Great. Great. Yeah, thank you so much. Yeah, I think I agree with Paul on that, that yes, producers may want to better understand how these programs works and to a large extent how it would impact the maybe their, like you were saying, their break-even prices
Yeah.
as well as if it will be bringing something into their pocket at the end of the day. So maybe they would, like Paul was saying earlier on, cut back on how much they are going to spend on crop insurance. For that, maybe we are yet to see, but for sure we know that government will be spending more definitely over the period. But then
Mm.
for producers, the effect, like Paul was talking about earlier on, we cannot definitely pinpoint what might be unless we have done all those analysis later on. So my prediction, I would say maybe more interest. We should expect more interest,
Yeah.
like Paul said, and then see how things go forward. Thank
Yeah.
you, Jeff.
Yeah, great. And I'll just note that neither of you said like cut back on inputs, right? Like maybe some of these things happen, but really, I think most farmers are optimizing already pretty close
Yeah.
to
I
their margin, right? So it's not like we can just cut back on a big fertilizer expense, right? We still need to
yeah.
be fertilizing close
Yeah,
to
I
those.
think they squeezed all the
Yeah,
squeeze they can out of the input side. There's just
yeah,
not much left to squeeze out. So now they're looking for some other things. Better marketing is always a good recommendation, but yeah, we'll see. We'll see. I think, like I said, there's gonna be a lot more interest, and I think there are gonna be questions for the professional ag economists here on the online to
yeah.
help think about these things.
Makes our jobs harder, right?
Yeah, yeah.
So,
Yeah, it's an interesting thought though, that if more people are shifting from ARC to PLC, then you're kind of decoupling that local weather risk, right? And it's placing all of that insurance basically on market risk. So
Yeah.
that could pay off, and it may bite in the end, right? So,
I right now don't have an answer which one's going to be better. I need to sit down and really look at the numbers and think about it. And like I said, I think it's going to be complicated. This year PLC bears looking at. I'm not sure I'm going to say yes, adopt it, but it definitely needs to be looked at. Before it was never a big choice, but now, yeah, those PLC price floors are much higher and relevant, and so we got to really think about this decision, what we're going to recommend. We'll just have to wait and see.
yeah, wait and see. I think that's kind of
Yeah.
that's maybe our favorite phrase as economists.
The signups aren't until mid-March, so we've got time yet. So we've got time.
Great. Well, we'll wrap up there today. We're at time. Please join us again next week. Our conversation will be led by Kelly Wilfert on legal and tax changes within the One Big Beautiful Bill. There were some pretty key things. There are things that I don't necessarily understand, and so that's why we have an attorney on our extension staff to be able to sort through those issues. So thanks everyone for joining, and we'll see you again next week at the same time. Take care.